There's an old saying that if you combine hot and cold, that on average, you're actually quite comfortable. And while that's technically true, it's a little bit misleading. And the same goes for investing. So let's look into it.
This is Mark Perspectives. Today we're talking about how the average isn't average. I'm Cameron Irvin, and this is brought to you by Irvin Winborn. So we're going to take a look at the New Zealand equity market calendar year returns for about a 41-year span from the 80s all the way through 2020. And as you guess, because it's a chart, we've got some different returns listed here, positive returns listed in green and negative returns listed in red. And then here we go, the little blue line, and that shows the average return for this entire time period. Now, a couple of things here. First and foremost is that there's been a pretty handsome return in New Zealand equity markets ever since the 1980s. That's even despite the year of 1987, which you can see listed there as a big old red bar that dips down pretty far below. So returns being on average above 13%. Also bear in mind that out of all of these years, there's 41 years listed. Only 4 of these actual years came within 2 percentage points of that average 13%, which means it's between 11% and 15%. 4 out of 41, which means most of the time the average isn't actually being achieved. The return is actually going to be quite a bit higher or lower. It's also kind of significant the fact that the returns range from minus 46% in 1987, pretty painful year, all the way up to 149% in the mid-80s. And that's a really fun year to be investing, but again, there's a big range between those two. So both of these are actually, in fact, part of the average. And if we take a look since 1980, the returns have been positive 30 times and only been negative 11 times. So some quick math says, 3/4 of the time, you actually end up getting a positive return. So if you want to make decisions to buy and sell a portfolio, or specifically sell a portfolio in order to avoid a dip, chances are the following year is going to be positive. At least most of the time, any year is going to be positive. But, as always, we should probably pause. Take a quick second, think about this. What we're looking at, is this just New Zealand? Are we the only country that has returns kind of like these? Well, let's have a look and see elsewhere around the globe and what it looks like. So we'll look over at the Yankees at the same time period and kind of see what those crazy kooky Americans are doing over there. And we see a story with a bunch of green lines of positive returns, a few red ones again, and the average. Now the average here is closer to about 11.5% per annum, 11.6 to be more precise, but it actually looks pretty similar. The average return being above 11% for the last 41 years, that's pretty good. 11% return over 40 years means $1,000 turns into many, many more dollars. Also, bear in mind that, again, the same example that 2 percentage points plus minus of 11%, meaning 13% down to 9% as a positive return, that only happened another 4 times out of 41 years. So we have New Zealand, which is one country, and the US, which is another country, and they both had this same pattern, where only a couple of times, 4 to be precise, the returns end up being close to what the average is. It's also worth noting that the returns in the US have been a lot more muted. So the lowest return was 37% in any given year, and that was the global financial crisis. In New Zealand, we didn't suffer nearly as badly as that. On the other hand, in 1987, we suffered a lot more than what shows on the chart here. So bear in mind that these returns did offer lower returns on average at 11% in the US versus 13% in New Zealand. But bear in mind, there was also less volatility. The range of returns is only between negative 37 and positive 36, as opposed to New Zealand, which is positive 149 and minus 46. So we have a lower risk profile from this. Also, we see that since 1980, the returns have been positive 33 times and negative 8 times. Again, kind of saying the same thing. It looks like there's actually been a lower amount of risk in the US markets. Lower range of returns, lower returns, and more often than not, more positive returns. This all kind of plays into the average, but again, just 2 countries. So let's take a look around the rest of the world. In the world, we exist as New Zealand, and here's the 50 biggest publicly listed companies in New Zealand that make up our index, the NZX 50, listed out and broken down by individual sectors. But New Zealand is a small country, so we've also looked at the US, which is represented here by the S&P 500 and its main sectors and industries. It's a lot larger than us, and they have a lot more companies. But then we have the rest of the world that we want to look at, and that's represented here. This includes 50 other countries, both developed and emerging markets, that are listed out, and this might make up a portfolio, for example. So when we talk about the total world equity annual returns, that's really what we're considering. Now we'll notice here that in this slide, it only goes back to 1986, so we have lost 6 years, but we still have 35 years of data, and we have the average annualized return of a little over 7%. Of the 35 years, here's what's interesting is that the average return was only achieved twice within 2 percentage points. So between 5 and 9%, that happened 2 times over 35 years. Same story. The average isn't going to be expected in any given year, even though it is the average. It's just kind of interesting. So here are our takeaways for today. Firstly, the average investment return should not be expected in any one year. If we're going to expect anything, it should be something that's either higher or lower. Investments in share markets and most volatile assets are not consistent, and that's part of the risk and why we expect to get a good return. Secondly, it can take a very long time to get the average. It might be 10, 20, or 30 years, so it's not something that we would expect to happen within the first few years. It could happen, but really the average is, you need a little bit more data to expect that. And finally, when investments do take a big drop, or a very big gain for that matter, that's part of the average. The average has already factored in these outlier and extreme events. So when we see a big decline, like say in COVID, the global financial crisis, Russia invading another country, that is part of the average already.
If you enjoyed this video, reach out. You can always find us at our home on the web at irvinwinborn.co.nz, email, or LinkedIn.